What if I told you that the greatest financial collapse in human history is coming? It's already been designed, engineered, and set into motion. What if the system isn't broken, but working exactly as intended, just not for you? Here's what they don't want you to know. The derivatives market, that shadowy $13 trillion casino hidden inside the global banking system, wasn't created to manage risk. It was created to transfer it. From the wealthy to you, from Wall Street to Main Street, from this generation to the next. And the blueprint? It was drafted decades ago by the same institutions now telling you everything is fine. You feel it, don't you? The rent that swallows half your paycheck. The groceries that cost 20% more than last year. The job market that demands a master's degree for entry-level wages. That's not inflation. That's not a recession. That's the controlled demolition of the middle class, and the fuse was lit in the shadows of private banking rooms you'll never see. So let me ask you, where are you watching from? Drop your city in the comments. Let's build a community that sees through the illusion. And if you are ready for the unfiltered truth about how the financial elite designed the trap we are all living in, hit that subscribe button. Because what I'm about to show you will change how you see every bank, every government promise, and every economic headline for the rest of your life. Let's go back to where it started. The year is 1994. Most people remember it for Forrest Gump and the O.J. Simpson trial. But in the sterile conference rooms of J.P. Morgan Chase in New York City, a small team of quantitative analysts, quants, they called themselves, invented something that would quietly rewrite the rules of capitalism forever. They called it a credit default swap, a CDS. The pitch was elegant, almost beautiful in its simplicity. What if banks could package their risk, the risk that borrowers might default on loans, and sell that risk to someone else? Like insurance, but for debt. If the loan went bad, the buyer of the swap would cover the loss. The bank would walk away clean. Risk neutralized. Profit preserved. Sound familiar? It should, because this is the exact logic behind every too big to fail bailout. Every quantitative easing program, every time the Federal Reserve steps in to stabilize markets while your savings account earns 0.01% interest. The game hasn't changed, it's just gone global. But here's what they didn't tell you in 1994, and what they are still not telling you now. When you allow institutions to offload risk without consequence, you don't eliminate the risk, you just hide it. You make it someone else's problem. And in this case, that someone else is you. By 2000, credit default swaps weren't just a niche product. They were everywhere. Banks weren't just insuring loans anymore, they were betting on them. Speculating. If you thought a company might fail, you could buy a CDS on their debt and profit when they collapsed. You didn't even need to own the underlying asset. It was like buying fire insurance on your neighbor's house and then handing them a box of matches. Sound familiar? Because this is exactly what happened during the 2008 financial crisis. Except the house wasn't your neighbor's, it was the entire American mortgage market. And the matches? Those were subprime loans bundled into mortgage-backed securities, sold as AAA-rated safe investments, and insured by credit default swaps that were supposed to make everything okay. Spoiler alert, they didn't. But let's rewind even further. Because the blueprint for this disaster wasn't drawn in the 1990s, it was drafted in 1971, the moment President Richard Nixon severed the dollar's link to gold. That was the day money stopped being a store of value and became a tool of control. Fiat currency, backed by nothing but government promises and military might, gave central banks the power to print unlimited money. And with that power came the ability to create unlimited debt. And here's the kicker: debt in this system isn't a bug, it's a feature. Think about it. Your credit card debt earns the bank 15 to 25% interest. Your student loans? 6 to 8%, compounding over decades. Your mortgage? 30 years of payments, where the first 15 years are almost entirely interest. The system isn't designed to help you build wealth, it's designed to extract wealth from you, slowly, quietly, perpetually. Sound familiar? It should, because every time you hear about record corporate profits, while wages stagnate, every time the stock market hits an all-time high, while homelessness rises, every time billionaires add another zero to their net worth, during a so-called recession, That's not a coincidence. That's the derivatives machine working exactly as designed, privatizing gains, socializing losses, and keeping you on the hamster wheel. By 2007, the global derivatives market had exploded to over $600 trillion in notional value. That's not a typo, 600 trillion. For context, the entire global GDP that year was around 55 trillion. The derivatives market was nearly 11 times larger than all the goods and services produced by every human on Earth. And nobody was paying attention. Why? Because derivatives are complex, intentionally so. They're designed to be opaque, traded over the counter in private deals between institutions, with no public exchange, no transparency, and no accountability. It's a shadow banking system, operating in parallel to the regulated economy, where the rules don't apply and the stakes are incomprehensible. Until they're not. So who built this machine? Who looked at the global financial system and said, you know what this needs? More leverage, more complexity, and less oversight. The answer is a woman you've probably never heard of, but whose fingerprints are on every financial crisis of the last 30 years. Her name is Blythe Masters, and in 1994, as a 25-year-old vice president at JP Morgan, she didn't just invent the credit default swap. She sold it. She convinced regulators it was safe. She told the world it would make the financial system more stable. She lied. Or maybe she believed it. Maybe she genuinely thought that spreading risk across thousands of institutions would dilute it, contain it, neutralize it. But here's what actually happened. It metastasized. Like a cancer hidden in the bloodstream, the risk didn't disappear, it infected everything. By 2008, Blythe Masters had become one of the most powerful women in finance, running commodities trading for JP Morgan. And when the credit default swap market imploded, when Lehman Brothers collapsed and AIG needed a $185 billion taxpayer bailout to cover its CDS obligations, Masters was untouched. JP Morgan survived. The architects walked away clean. And you got austerity. You got foreclosures. You got a decade of stagnant wages and rising costs while the Fed pumped $4.5 trillion into the banking system through quantitative easing money that inflated asset prices for the rich while doing nothing for working families. But here's the part they don't want you to know, the part that keeps me up at night. The derivatives market didn't shrink after 2008. It grew. Today, it's estimated at over $1 quadrillion. 1,000 trillion, and the same institutions J.P. Morgan, Goldman Sachs, Citigroup, Bank of America control over 90% of it. You won't believe the name of the regulatory body that's supposed to oversee this market, and the receipt is wilder than you think. Let's break down exactly how the system works, because this is where the illusion becomes crystal clear. A derivative is a financial contract whose value is derived from an underlying asset, a stock, a bond, a commodity, a currency, or even another derivative. Think of it like a bet. You're not buying the asset itself. You're betting on what the asset will do in the future. There are four main types: futures, options, swaps, and forwards. But the real monster, the weapon of mass financial destruction, the swap. Here's how a credit default swap works in practice. Let's say Bank A has loaned $100 million to a corporation. Bank A is worried the corporation might default, so it buys a CDS from Bank B. Bank A pays Bank B a premium, let's say $1 million a year, and in exchange, if the corporation defaults, Bank B covers the loss. Simple, right? Insurance. Except here's the twist. Bank C, which has no exposure to the original loan, can also buy a CDS on that same corporation's debt. Bank C is just betting that the corporation will fail. If it does, Bank C collects. This is called an uncovered CDS, and it's pure speculation. No skin in the game, no actual risk being hedged. Just a casino bet dressed up in financial jargon. Now multiply this by millions of contracts, trillions of dollars in notional value, and zero transparency about who owes what to whom. That's the modern derivatives market. And here's the moral hazard. If you're Bank A, and you know you can offload your risk to Bank B, why would you ever stop making risky loans? You wouldn't. You'd make more, riskier, because you're not holding the bag anymore. Someone else is. This is exactly what happened with subprime mortgages. Banks knew the loans were garbage given to borrowers with no income, no job, and no assets. The infamous ninja loans, but they didn't care, because they weren't keeping the loans on their books. They were bundling them into mortgage-backed securities, slicing them into tranches, getting them rated AAA by complicit ratings agencies like Moody's and Standard & Poor's, and selling them to pension funds, insurance companies, and foreign governments. And then they were buying credit default swaps to bet against the very securities they had just sold. Let that sink in. Wall Street was selling you a product they knew was toxic, then taking out insurance to profit when it exploded. Goldman Sachs did this. They created a mortgage-backed security called Abacus 2007-AC1, marketed it to investors as a solid bet, and simultaneously shorted it bet against it using credit default swaps. They made billions. Their clients lost billions. And when it all came crashing down, Goldman got a $10 billion taxpayer bailout through AIG's rescue. Heads they win, tails you lose. But here's the even darker part. The bailouts weren't a bug. They were a feature. The too big to fail doctrine didn't emerge in 2008, it was baked into the system decades earlier. In 1998, a hedge fund called Long-Term Capital Management nearly collapsed. LTM had used massive leverage borrowed money to make bets on bond spreads using derivatives. When Russia defaulted on its debt, LTM's models broke. They were leveraged at 100 to 1, meaning for every $1 of their own money, they had borrowed $100. When the bets went south, they owed over $100 billion to every major bank on Wall Street. The Federal Reserve, terrified of a systemic collapse, orchestrated a private bailout. 14 banks chipped in $3.6 billion to keep LTM afloat. No taxpayer money, technically. But the message was clear. If you're connected enough, if you're systemically important enough, the rules don't apply. This is the blueprint. Privatize the profits, socialize the losses, and when it all falls apart, the public pays. After 2008, the Dodd-Frank Act was supposed to fix this. It created the Commodity Futures Trading Commission's oversight of the swaps market and mandated that standardized derivatives be traded on public exchanges. Transparency, accountability. Guess what happened? The banks lobbied hard. They spent over $5 billion between 2009 and 2012 on lobbying and campaign contributions. And they won. The regulations were gutted. Exemptions were carved out. The derivatives market remained largely over-the-counter, opaque, and unregulated. Today, the Office of the Comptroller of the Currency reports that just 4 US banks hold over $97 trillion in derivatives exposure. JP Morgan alone holds over $50 trillion. That's more than twice the US GDP. One bank. And here's the scariest number. Of that $50 trillion, only about $2.3 trillion is exchange-traded and transparent. The other $48 trillion? Private deals. No public record. No way to know who's exposed to what until it's too late. Sound familiar? Because this is exactly the structure that triggered the 2008 crisis. And it's bigger now, faster, more leveraged, more interconnected. And when the next shock hits the system, whether it's a sovereign debt crisis, a commercial real estate collapse, a cyber attack, or a geopolitical event, the derivatives market will amplify it. Here's why. Modern derivatives are tied to everything. Interest rate swaps alone make up over 70% of the market. These are contracts where institutions bet on the direction of interest rates. When central banks held rates near zero for over a decade after 2008, trillions of dollars in swaps were written, assuming rates would stay low forever. Then, in 2022, the Fed hiked rates faster than any time in 40 years, from 0.25% to over 5% in 18 months. Trillions of dollars in interest rate swaps suddenly went underwater. Banks like Silicon Valley Bank, which had bet rates would stay low, saw their bond portfolios collapse. SVB failed in March 2023, triggering a regional banking crisis. The Fed stepped in again with the Bank Term Funding Program, offering loans to banks to cover their losses. another bailout, another transfer of risk from private institutions to the public balance sheet. And the derivatives exposure? Still there, still growing, still hidden. This is the parasitic finance model. It doesn't create value. It extracts it. It doesn't build economies. It hollows them out. And it doesn't serve the public. It serves itself. The elites didn't just design the system. They rigged it so that every crisis makes them richer, every bailout makes them more powerful, and every collapse makes you more dependent. This is the blueprint, and it's working exactly as intended. So where does that leave us? The derivatives market is now estimated at over $1 quadrillion. That's 1,000 trillion, 15 times global GDP. It's a shadow economy, larger and more powerful than every government on earth, operating with no accountability, no transparency, and no plan for when it fails. Because it will fail, not might, will. The question isn't if the next financial collapse will happen. The question is when, and whether we'll finally admit that the system isn't broken, it's working exactly as designed. Here is the lesson they don't want you to learn. Every major financial crisis in modern history, the Great Depression, the savings and loan crisis, the dot-com bubble, the 2008 collapse, the COVID market crash was preceded by the same pattern: deregulation, excessive leverage, opacity, and a collective delusion that this time is different. It never is. But here's what is different now: the scale. In 1929, the crash was regional, slow, and analog. In 2008, it was global, fast, and digital. The next one will be instantaneous, algorithmic, and interconnected across every market, every currency, and every asset class on the planet. And when it comes, the same people who built the bomb will be the first ones out the door. They'll short the market on the way down, buy assets at the bottom, and lobby for another bailout on the way up. They've done it before. They'll do it again. Unless we stop pretending. Stop pretending that the experts have it under control. They don't. Stop pretending that the markets are rational. They're not. Stop pretending that the system serves you. It doesn't. The 1% didn't just design the coming collapse. They built the entire architecture to ensure they profit from it. The derivatives market isn't a mistake. It's a machine, and you're the fuel. So here's my challenge to you: share this video. Not because I need the views, but because this information is actively suppressed. The mainstream financial media won't touch it. Your economics professor won't teach it. Your bank definitely won't explain it. But you deserve to know. You deserve to see the blueprint. And you deserve to ask the hardest question of all: are we wiser now? Or are we just walking the same path in better suits? Drop your thoughts in the comments. Tell me if you think I'm wrong. Tell me if you've seen this pattern in your own life. And if you want more videos that cut through the lies and follow the money to the truth, subscribe. Because this is just the beginning. The house of cards is taller than ever, and gravity hasn't been repealed. It's only a matter of time.